As index funds become increasingly popular, you might even receive recommendations from those with no financial expertise. This can lead new investors to question whether the hype is too good to be true. Today, I'll explore the roots of this concept, explain why investing in index funds doesn't require a deep financial background, and share the best strategy for those ready to jump in. First, let me introduce the key figure behind this movement, John Bogle, the founder of the Vanguard Group. Vanguard is now the world's second largest asset management company with $8.7 trillion under management. Bogle introduced the first index mutual funds for individual investors and stood behind the concept until it gained widespread acceptance with an unprecedentedly low expense ratio. His vision of low-cost, passively managed funds revolutionized the investing world, helping millions of everyday investors build millions in wealth. When it comes to investing, the rate of return is usually the first thing we try to figure out. It's human nature. We are naturally drawn to high returns. However, Bogle warned that investors should be cautious about chasing recent high performers, whether in individual stocks, mutual funds, or entire markets. Based on his research, he believed that extraordinary returns are often unsustainable and that the long-term performance of investments will eventually revert to their historical average, a concept he called reversion to the mean. This mindset encourages us to look at the bigger picture rather than get caught up in short-term gains. This also ties into another key investing rules, setting realistic expectations. Don't aim too high based on a few exceptional years. Take the S&P 500 index fund, for example. In 2024, it achieved an 18% return year to date, which might tempt many to jump in, expecting similar results. But if we look at historical data, the S&P 500 has averaged around a 10% yearly return over the past 100 years. This year isn't typical, and we shouldn't expect an 18% annual return to become the norm in the coming years. So when investing in index fund, focus on the historical average return as your target for the future gains. In our last session, we discussed Bogle's reversion to the mean rule, highlighting that investing in individual stocks often comes with significant volatility. To mitigate this, Bogle recommended investing in a broad-based index fund that captured the entire market. This strategy offers diversifications, reduces the risk of trying to pick individual winners and losers. He famously coined the phrase, "Forget the needle, buy the haystack," which underscores the idea of investing in the entire market rather than searching for outstanding stocks. This is the foundation of why putting your money into index fund is popular now. When it comes to choosing what to invest in, Bogle emphasized simplicity. He suggests that one well-diversified index fund is more than enough. For example, the Vanguard Total Stock Market Index Fund or any equivalent on the market will be an excellent choice. If you have a higher risk tolerance, you might consider the S&P 500 Index Fund, which is also highly recommended by Warren Buffett for its strong long-term performance. Once you selected a specific index fund, there's one more critical aspect to consider before making a purchase: the fund's expense ratio. The expense ratio represents the cost of holding an index fund. Bogle's advice here is straightforward. Choose an index fund with a low expense ratio. He made a classic comparison: Fund A with a 10% annual return and 0 fees, versus Fund B with a 10% annual return plus a 2% expense ratio. While both funds had the same gross return, Fund B's high expense ratio would reduce your net return to 8% annually. If you invested $10,000 in each fund, Fund A will grow to $450,000 over 40 years, while Fund B would only reach $217,000, less than half of the Fund A's return. This illustrates how high expense ratio can significantly erode your profit. Fortunately, thanks to Bogle and his firm Vanguard, the revolution for low-cost investing has made extremely low expense ratio index funds widely available to the public. Today, most major index funds are competitively priced, with expense ratios differing by just a few hundreds of a percent. But if you are really picky about fees, it's worth taking the time to select the funds with the lowest expense ratio. Bogle's approach to buying and holding strategy can be summed up in two key principles. First, buy right and hold tight. Second, time is your friend, impulse is your enemy. These principles are straightforward and work hand in hand. Once you've selected a well-diversified index fund with a low expense ratio, the next step is simple: hold on to it for long term, regardless of market fluctuations. Timing the market or obsessing over the perfect entry price isn't necessary at all, as long as you're committed to holding your investment over time. Historically, some of the stock market's best days have occurred shortly after significant downturns. If you attempt to time the market or wait for a better entry price, you risk missing out on these crucial days, and the impact can be substantial. For instance, a study from JP Morgan shows that if you invest in $10,000 in the S&P 500 index in January 2002 and left it untouched for 20 years, you would have more than $60,000 by January 2022, reflecting a 9.5 average annual return rate. However, if you frequently move in and out of the market and miss just the 10 best days during this period, your return would be 55% lower. I know it sounds crazy, but it is true. And let's not forget the power of compounding, which you've probably heard about many times. As Albert Einstein famously said, compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. If you were to invest $5,000 every week, essentially $100 a week into an S&P 500 index fund for 40 years, and assuming a conservative annual return rate of just 8%, you would end up with $1.3 billion. Your total contribution, just $200,000. The rest of the growth will be thanks to the magic of compounding. To wrap up, John Bogle's winning formula for index fund investing is straightforward. Start by setting realistic goals for your investment. Choose a well-diversified index fund with a low expense ratio. Keep buying consistently and hold up tight. By following these steps, you'll be well on your way to long-term success. To justify this strategy, you can check out the other series where I've been investing $50 every week into the S&P 500 Index Fund ETF VOO for more than 2 years. I think the performance speaks for itself. Lastly, let me leave you with Bogle's final piece of advice: stay the course. Happy investing. I'll catch you next time.